Might be an action close today, so let's try and do 250 to 3 if that works. Out with the old, in with the less old. Test, test. My audio is on. Matthew, you want to tell me how that sounds for me, por favor? Could be a fun session here today. Down 90 points right now. Who's got questions? We got a great lineup today. Noel Smith, Phil Streible, Jeff Garbaz, Scotty B. Good afternoon. Welcome to Chicago Future Finance. I'm Oliver Rennick. It's 2 p.m. We've got 1 hour left in the day here. Equities are under some pressure. We are buckling a bit as we struggle under 6,800. Khameini Jr. takes over Iran. Maybe not the most bullish thing. I've been a little stubborn on the risk radar, looking for hope in stocks, but the green light that I've had, I think time to respect the technicals. Whoever in chat yesterday said it should be yellow is probably right. Kind of knew it should be yellow. So yellow on stocks, range bound, still overall is not the worst outcome. We're still above the recent lows that we had just recently made. But obviously, the further we get under 6,800, the more potential that steady climb in VIX to go asymmetric to the upside seemingly is. Look at that chart for VIX. The volatility had that big pop, red candle, came back down, but the uptrend still is holding. That looks a heck of a lot like the chart of crude oil, where we had a big candle and then it came back down, and we continue the uptrend. So again, generally speaking, across the long time horizon, geopolitics are like the number one opportunities to buy the dip, the main brick in the wall of worry that keeps markets healthy to reprice around fear, and then resolution brings continued strength. But that being said, I'm not a geopolitics expert, but I can certainly see the bear case kind of forming here around Iran. Out with the old, in with the less old. I'm not a geopolitics expert, but I don't really think bombing one guy to get his son in, which is kind of like that episode of Seinfeld where like they're all super old, the Mandelbaums, like his son is doesn't look like a particularly modern guy. So out with the old, in with the less old. I'm also not a licensed therapist, but I don't think generally people whose dads just got bombed feel very strongly about the people who did it. So look, the main point though generally is that when it comes to actually action, putting trades on, the volatility landscape hasn't really changed a ton. We're mostly still range bound. VIX, yes, is still steadily creeping, but it's mid-20s. And right now we are off about 100 points, roughly 95. So we're getting close to what the VIX says should have been the move. About an hour ago, it looked like the market should have been down a bit more, just based on simple kind of rule of 16 volatility, options math, a 25 VIX. Looked like we needed about a 1.5% move. We're getting closer to that now. But for the most part, this has been an environment in which using volatility to your advantage still has been a good thing and a useful thing. However, we're definitely bleeding out here. That being said, from a technical perspective, 6,600 has been a line that we drew here really weeks ago that had support back in September and November of last year when we talked with our guests, Brent Kochuba, Noel Smith, the Nigerian brothers, about the potential for unwind. We all kind of looked at that technical level of 66 and we never actually got to it. So if you're looking for that washout, there still technically could be some support down there. I think if we break 6,600, then maybe the red light goes on. I'm generally approaching the Iran situation similar to how I did the COVID situation, which is that when there are these exogenous risks that have the potential to have major convex asymmetrically negative outcomes, but usually don't. Geopolitics usually fade. Health scares usually fade. I stay yellow until there is real technical breakdown. And if you actually were following my coverage years ago during COVID, it was pretty much the same, where I kind of missed the first 5% off the S&P 500. But as soon as it started falling apart in late Feb, I got quite bearish and said that things were likely to break down in a meaningful way. So that's where we're at right now. I still generally hope maybe is not a strategy, but logic generally is. And for the most part, these geopolitical things are good logic for dip buying, or at least premium collection and harvesting if you get smart and go into the options market, which is exactly what Mr. Noel Smith likes to do at Convex Asset Management, joining me on the Zoom. Noel, what's going on? Good afternoon, sir.
Hey, how are you?
Doing pretty good. It's a little action down here. You know, we're close to the lows of the day. We're basically at them right now, 66.84. We just hit below 6,700 about an hour ago, and we're kind of losing it. So tell me what you're looking at here in the market. What stands out to you?
You know, I was talking with one of my colleagues earlier, and one of the things that I thought about highlighting on our hit today is if you look at the skew in the S&P 500, right? In other words, there's a lot more skew. There's a lot higher skew than usual. And as you start to get into these lower and lower strikes, the VIX beta to the stock market starts to increase, because what happens is the slope of the ascension of that term structure starts to move around more. So what you're going to start to see if we start going down more is VIX will be more reactionary vis-a-vis the S&P 500 than it typically would be. So it will be increasing at an increasing rate.
Okay, and that's not a good thing. That's also what could maybe wash us out. That's kind of the idea of that uptrend line in the VIX that I've had, extending. We used to come down and touch that thing about once or twice a week. Not lately. It kind of looks like it's losing ground, like a balloon flying away a little bit.
Yeah, you're right. And also your point earlier about expected vol versus realized vol, and we're still within range. As much, we're down 130 bips or whatever right now, and things look like they're dire, but they're not that bad. And also, I think that the idea of stagflation from a macro standpoint is starting to kind of come into the consciousness, which is to say that jobs are going to be maybe weak, inflation is going to go up, so that's why we call that stagflation, a stagflationary economy. With higher inflation, because if oil continues to stay high for whatever reasons, right? Obviously Iran, the idea that we can cut rates if the economy starts getting weaker, that narrative starts to shift. So if you look at the Fed Fund futures market, the idea that we're going to have a bunch of rate cuts this year, it's getting lower and lower.
That fits with the imminence of data, which I do think is somewhat important as well in this conversation. As you mentioned there, we do have a few things coming up tomorrow. Today's jobless claims were fine, but tomorrow we've got durable goods, we've got a GDP read, we've also got personal income and outlays, PCE, as a main indicator there, obviously. After the CPI hit with expectations, market didn't freak out, but to your point, this is messing up some of the expectations for Fed cuts. I was never one that thought we needed Fed cuts, but if the market had priced that in, who cares what Oliver Rennick thinks? That's going to matter if we price it out.
Yeah, I totally agreed. And also bear in mind that, a lot of the stuff that are the macro indicators, that is not in sample for PCE or CPI. That'll be more effect, next month. So, the idea that, gas is going to be $5 or $50 in California, that hasn't happened yet in so far as those macro data points go. So this stuff is kind of in the future. So you want to look at either forward predicting indicators or coincident indicators. But these things that are lagging, the data's not there yet.
Yeah. So interest rates, the next meeting is kind of a non-issue. But I'm pulling up Kalshi right here. Let's go there to see what they say about the next Fed rate hike. Because that one, does kind of maybe get to an interesting conversation. There's some volatility here in this contract. Before 2028 has quickly zoomed past before July 2027. Generally before 2027 was never a high odds thing, but it hasn't moved. So the fact that now you're getting before 2028, extending past before July 2027, we're pushing that out. So that kind of adds on another thing for us to figure out here. What's, of course, I think important too for people to remember is that as we're pushing out the possibility of a rate rate hike, the interest rates are going up. And that's important because people got to remember that is backwards now. As yields go up, it's corresponding with pushing out, the hikes. So you get to some interesting places there where folks might have to start thinking about bonds as a factor.
Absolutely. So something that, when I was running my prop firm, guys would come in and give me these stories about whatever they thought was a good trade. And I would always try to cut them off and be like, okay, great story. I don't care. What's the trade? So if you look at interest rates going up, 10-year calling it 4.3%, give or take, bear in mind that as a mechanical part of options pricing, as rates go up, calls get richer and puts get lower. So what you're going into is a questionable environment for the direction of the marketplace. There isn't a clear path for rate cuts. In other words, even if Trump wants to cut rates, he might not be able to without wildly taking inflation out of control. So it really does, the summation of this, what's the trade? This is a stronger environment for buy rights, options selling, premium harvesting. Vol is high, The path of rates is uncertain. The idea that we're going to have in a stagflationary environment ticks a lot of boxes for the idea of options writing to create income where there otherwise might not be some, or if you're not able to extract alpha from the marketplace or directional profits from the marketplace, you can get some of those returns from option selling. And I think the environment for that is better than it's been in a while. So I would look, if I were listening to me talk right now, I would look for opportunities to sell options in a risk-defined way.
And we're thinking in the same lines here, because especially with the overall range holding, I know we're slipping out of that range to the downside, but again, that was kind of my point about the technical analysis with 6,600, because if you stretch back to fall last year, the range becomes 66 to 7,000. In the last couple months, it was 68 to 7,000. But, we're still fairly contained based on the last 6 months of trading. So when you have elevated vol and some definition of a range holding, buy rights, iron condors. The world is kind of your oyster if you know how to use options right now.
It's a great environment for options. It really is. So there's a lot of opportunity for people that are paying attention. If you're listening to this broadcast, you probably are. If you're listening to somebody like me, you probably are interested in options. And I think the opportunity set now is greater than it's been. And also the idea that, Trump could turn everything around on a dime, we're going from tweet to tweet. So there is going to be some kind of a range within the marketplace. So I really do think that the environment is getting better and better for something like selling out of the money calls, selling defined risk strategies within the options marketplace.
Okay. An easy done if you've got existing equity holdings, obviously, but, in terms of new positions too, right? Spreads, if you want to speculate on some of the earnings related stuff. Adobe actually today is about the same as the market performance. That was one of the worst performing cloud names. But it is, I will admit, as we get closer, to the bell here, it is hard to find stuff that's doing great today. Noel, most sectors are down, but energy's up, obviously, utilities and staples. So you've got some kind of defensive trade. But I bring up Adobe because, the software group is only down 60 bips today. So at least the stuff that they took to the woodshed over the last month and a half, it seems like we're done there for now. So I don't know. I'm really digging to find some sign of positivity, but that's arguably one of the groups.
Enron bounced. Just because stuff bounces doesn't mean it's not going to keep going down. I'm in love right now with AI. I'm in the honeymoon phase. Do I think that Claude or GPT or whatever is going to take more software jobs? I absolutely think that's going to happen. So the stagflationary narrative, I think, is a good one. Rates up. You don't know what's going to happen with energy. The idea that software stocks, we'll see what happens with Adobe today, but man, that's a tough narrative to just think that all of these companies are going to stay where they are. Now, let me qualify that with a little bit more nuance. Adobe stock could go up if they fire half their workforce, right? Is that necessarily good for Adobe? Sure, if they were able to cut their payroll in half like Block did. So that doesn't mean that these stocks will go down, but that also does continue to put pressure on the stagflationary narrative because unemployment could go up. And these are well-paying white-collar jobs. So that segment of the marketplace and that segment of the economy could continue to struggle, which goes right back into the whole, buy right or selling options theme. So there's nuance, but you could have both things, which is to say software stocks could bounce with them laying off half their workforce.
Since you mentioned it again, for those following along here, make sure we don't, lose folks behind us. I think for the most part, kind of a straightforward, strategy with the buy rights, but just pulling up because I'm loving using AI as my co-anchor, as the education tool for the show. Purchase the stock, sell the call option. Okay, it's basically the most simple kind of entry level, but it's popular for a reason, right? The covered call is like the step one for a very clear reason. Some things are stereotype or cliche. Sometimes stereotypes for a reason. You know what I mean? Sometimes things are popular for a good reason. This is the environment that makes these things popular, because let's say you do like one of these software names that's beaten down or whatever. Let's say you like a Microsoft, then all right, if you already own the shares, sell calls against it, or go and buy the shares, sell the calls against it. there's a reason why certain things are very popular, and as this is kind of the most basic thing, it's a reminder that this is an environment in which it works.
That's exactly right. I'm not really a buy right guy. It's not like something I've been doing with my life, but there's a time and a place for everything. And
Sure.
selling options now it's the time and the place to at least look at those ideas.
Yeah, I'm into it. We talked a little iron condors yesterday as well, things that kind of can capitalize on a range-bound trade. I would say lastly, to this point, correlations are picking up here, Noel, to follow up with where we left off on Monday or Tuesday rather, when you were on the show. Here's the chart of Core 1M. I'll kind of leave this as the last chart here for us. We don't generally want to see this go up too high if we're downtrending, right? That if we go, this is pretty close to making a higher high now.
I mean, I don't see why that's necessarily a problem. It really depends on your book. If you are short that,
Fair.
You don't want that to happen. But when we talked about this a couple of months ago, we said, we do trade dispersion and correlation, but the absolute value of those ideas was so rock bottom low as to we don't really want to be participants at those levels. So that's kind of the idea. So, if correlations went higher, we could sell volatility even richer. It's not so bad.
Yeah, fair enough. To your point, I just I generally, by default, I usually speak on behalf of the long investor, right? Because that's kind of like where most people are. Correlations, the upside, great in an up market. Correlations downside means we might be throwing things out. But to your point, that's where we could get opportunity too. And if it means that volatility is going to be elevated, then just harvest that in, or protect yourself so you don't blow up. Like it, Noel. Thank you, sir. Nice round trip from our Tuesday conversation. Noel Smith, appreciate it very much. Convex Asset Management. Have a great weekend.
Thanks.
See
Bye.
you, man. All right. Coming back. We're going to take a short little break. And then, there we go. A 2-minute buffer break. Then we're coming back with the Marc Rebellion team. We're going to talk about some of the geopolitical conflict, obviously, and the role this plays in. Going to look at some of the Kalshi stuff. Also, by the way, because underappreciated perhaps in this entire story is that there's a pretty major political shift happening, at least according to Kalshi. So I'm going to look at some of those next here. Which party will win the U.S. House? Democrats are extending their lead. Also, another one that's interesting is that Marco Rubio has surpassed J.D. Vance as the 2028 Republican presidential election winner. So there's definitely some things happening on the politics side. All right, we'll be right back. 2-minute break. Back in a moment.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection. Seeking to deliver more than 70% of the upside, and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, we're back here. Stocks are getting hit under some pressure. Big surge in WTI with another double-digit move, percent, and volatility up on the day. VIX pushing higher as we get down to lows. There's also some major political shakeup in the betting markets happening. Joining me, Jeff Garbaz from Market Rebellion. Hey, Jeff, great to have you on the show. Thanks for being here.
Hey, Oliver, thanks for having me. Kind of last minute filling in for Mark.
No, good, absolutely. You guys got a nice, good, deep bench over there. Tell me, kind of when you start in the analysis here, there's a lot of places to go. Obviously, crude oil is a big part of this, WTI. There seem to be some political implications. The Kalshi bets are repricing a lot on the political stage. But also, if you want to go like pure technicals, the market and the S&P just kind of slipped below support. What's your perspective? Where do you begin?
Let me tell you, let me just go over this way. There we go.
Yeah.
A little bit about what we do or what I'm doing for Market Rebellion. Number one, I host a morning show with Ryan Mastro where we kind of go through markets and stuff that's going on. And then after that, we do some intraday trading stuff. But I also have two products that are called squeeze plays. And we look
Give me
at
some squeezes, baby. I'm ready to squeeze.
We use short interest to figure out whether to buy calls or puts.
Okay.
And we also look at not only short squeezes, but what we call a long squeeze. A long squeeze is an awesome term. It's where basically too many people are long and no one is short. So as the stock goes down, there's no shorts covering, and it just drops and drops and drops over time. So it was funny. You guys were just going through Adobe, and our work has some really cool stuff on Adobe. You want me to
Hand me,
through
baby.
it?
I'm ready for the action.
Can I do a share? Is that okay to do?
Probably not.
Okay.
Talk me through it. I got the chart in front of me.
Okay, great. So I'll just walk you through. So
Yeah, you can try.
What
I
we
can
do?
try to pull you up on full screen if you want.
You what?
I can try and pull you up on full screen if you want.
So you want me to? I'll hit the share thing and see what happens. Okay.
Okay. Blast it.
There we go. Did we get it? Did it come in?
Booyah. Okay. All right, cool. Take me
There
through it.
we
Which
go.
one? You got a lot up here.
Okay, we'll do this one first. This is very simple. So here's what is unique about what we do is we once we know how many shares are short, we build our own short ratio unique to anyone else's. Then we look at the range of that. So right now, the short selling in Adobe is at 100%. So basically, these shorts have been making money on the way down. How do we know that? We quantify that over here. Let's just take a quick look. Here's Adobe. And you can see so far the shorts have made 13.8%.
Okay.
And historically, in 18 times where it's had heavy short selling, the shorts have been squeezed 66.7% of the time, and they've made money a third of the time. And so the average squeeze, the stock goes up 16.8%. When the shorts make money, they make 11.4. So far, the shorts have made 13.8. So they've already made their maximum amount, so to speak. And once we know that, we come back here, and then we can look at put and call activity, and we can see we got these red dots here. That means that we got a lot of excess call buying going on right now as we're coming into this report. And then we go over here, we click on the volume, and we can see the volume has just turned positive for the first time since basically the beginning of the year. So we got a little bit of upside coming. And last but not least, we look at seasonality. So seasonality is about to end its negative period and turn positive. So I gotta go with the viewpoint that this thing could move up, not down on earnings. And
So
we
we're
could
like
actually
three? How many of those charts lean positive? We got 5 out of 6, 6 out of 6.
So this is a 1 out of 2. This is a lot of call betting, so this is a positive. It's starting to beat the S&P, starting to beat the sector, starting to beat the group, and volume just turned as well, and seasonality is about to turn. Yeah, so most of it is turning positive from a lower standpoint right now.
I like that. It fits with the general subject we've been talking about, which is the software group firming up. The worst performance.
Well, here's the
previous
crazy
3
thing.
months finally catching some love.
Well, here's the crazy thing about software right now. Because we have all this data on short interest, I work with this guy who came out of Fidelity, and we've been working with him for 30 years. But I know right now there is $285 billion short software stocks. Okay.
Uh-huh.
In the last 5 periods, it's gone from 330 billion down to the 285 number. So we're starting to
They've
see
been taking profits.
We're starting to see some covering for the first time. Shorts are taking some of their gains, and it's by far the biggest place where people have been short. And it's worked since last October. So now we got to see how it's going to play out, kind of going forward. And we're starting to see some of these names are popping up here. One thing that we're not seeing, though, which I'll show you this chart. This is kind of cool, and you can see it on.
Once you
on
get
Shopify.
one chart up, I'm going back to you because you're making my eyes bleed with all them. There we go. I like that.
There you go.
Okay.
Here's the one chart. This is the Erlanger put call 10-day ratio, and you can see it's popped a little bit. But I'll show you a chart where it really popped. Was on. Look at Shopify. Look how that climbed. When this put call climbs and a stock's at a low, that's a signal that it's going to turn around and pop, and that's what happened with Shopify. So
that's the squeeze, right? You're getting lopsided down at the lows.
Yeah, it went from 110 up to 130 in a couple of weeks. So a very quick move to the upside, and so right now we just got the latest short numbers. Short numbers come out every 2 weeks. You can see like people have been covering Shopify. They've been taking their gains, and now it's starting to go back up a little bit, kind of bit by bit, in terms of what's going on. But for the overall market, we still have lots of shorts in the market. You can see
Jeff,
here.
I'm wondering if there's anything to be said about a shift between hardware and software, because I've been loving the semiconductors, but they're starting to break down a little bit, and folks in chat were asking if it's basically a spread trade now that's going to go in favor of cloud. If that's the way we express optimism in tech, is to go long cloud, short semis. Are they getting squeezed in the opposite over on the hardware side?
It's interesting that you say that. I will show you a chart.
Okay.
I'm gonna go here. Let's see. Pull it up.
Because the relative strength, while you do that, I got the relative strength up, which is starting to, after months, obviously, of software just getting wrecked. It's starting to tick up in the other way. It's not that I don't like the semis anymore, but maybe there is a point there to be had.
Here's our report. So right now, this shows you this is by sector, and right now there's 151 billion short of semis. Okay.
Okay.
Software's at 285 billion right now. So if people start covering their software short and they go into semis, the next time we get short interest data, we're going to see that movement. And to your point, the hardware space is at 123 billion. So we are probably the only people who have this data that do this tracking of this. We've been doing this for a long time. Have a lot of hedge funds that use our work, et cetera. But I like your idea that semis could become the next place where we start to see them getting hit a little bit and see some shorts going in there. But right now, it's done really well within the work. I'll just show you how we rank it right now.
Yeah, hit me.
And here you go.
Give me one more.
Semis are ranked number 4 in our sector stuff, and you can see how software is at 18, but it's improved in the last week by 5 slots. So it was down at 23, and in 1 month it's up by 6, so it was at 24. Whereas software, you what?
Software making the move, it sounds like.
Software is starting to make a move right now, and semis are at 7. So they're still looking pretty good. The tech rank is there, but you can see there's not a lot of shorts. Have the semis
dropped at all, Jeff, in the ranking?
The what?
Have the semis dropped at all in their ranking, on your ranking?
Yeah, they were at 1, now they're at 4. They haven't dropped out of being category, but I'm going to be watching this because the problem becomes if the tech rank goes and there's no one short these things and people have to leave them, then we're going to get a lot of quick price movement to the downside because there's no shorts covering out their position. Does that make sense?
Yep. Nobody left there to bid it back up. I like it. So the trade-off potentially may be real here. I like those stats, Jeff. Very helpful for software. I like that take. Yesterday I said Adobe was going to be one of the main charts to watch today, so I appreciate that. Thank you very much, sir.
That's been a fun one to take a look at.
Yeah, Adobe trying to make moves, trying to fit in with the sector move, a little strength out of the cloud. There he is. Jeff, we'll hit it again. Appreciate you very much. Thanks for popping in, sir.
Thanks for having me.
Absolutely. Fitting into a theme we were talking about earlier in the show. Glad we got back into it. Looking at software as maybe a potential comeback story. Got to have something working, and down, 0.5% right now? A lot better than the rest of the market. IGV down 50 bips, CLOU down 0.75. Jeff Garbaz, Market Rebellion, looking for the squeeze trades. I think a lot of people would like to see software squeezed, in particular if it's Microsoft, a big software name. Phil Streible on deck, talking crude oil, the man to go to for commodities, right after this.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, we're back here. S&P 500 down 83 points. We were worse off a few moments ago at the top of the show. We were at 66.80. We're a little bit above that right now, but still, it's been a bit of a rough session. Got Mr. Phil Streible joining me on the line from Blue Line Futures. Going to talk some crude. Phil, great to see you. How's that Florida weather treating you?
Oh man, it's beautiful down here. So yeah, it's been a volatile market in all these commodities across the board. It seems like we're going from one particular commodity segment. It was the precious metals markets in the late last year into January. Now we're shifting into the energy space. Even the agricultural products are seeing volatility as well. So it's global disruption. You know, with the U.S.-Iran conflict in week 2, that Hormuz disruption, the dominant macro driver here. So you look at crude oil up about 39% here since that February 28th breakout to the upside, and markets are just whipsawing on every Trump headline.
The WTI chart, I gotta say, if I didn't know any better, Phil, it looks like it wants to make another run, because when I see that long wick candle and then just immediate resumption of bullish behavior 3 days since, I'm not loving it if I'm short crude.
No, not at all. I mean, you have a defined range with the Monday high 119.48 to that spike low on Tuesday at 76.70. You look at the OVX, it's at 125. I mean, that's creating some serious conflict premium within the option space. But, you know, any kind of credible ceasefire with the war will be over soon. You could see a $10, $20 drop within 24 to 48 hours. But at this point, it seems like the disruption at this is just too great for the market to handle. So every dip is just getting bought at the moment. I can only imagine that airlines, cruise ships, freight companies, anyone who needs a lot of these things, diesel is really scrambling right now.
Royal Caribbean is down, lower by 6%. Airlines down 4%. Certainly painting a pretty clear picture. Jets ETF maybe coming up on support. Might be a good one to watch if that breaks down. That could be a tell that things are getting worse here for crude. I mean, look, like I said at the top of the show, Phil, I'm not a geopolitics expert, but bombing one guy to put his son in, I'm not sure how much progress that is. Again,
yeah,
not my area of expertise.
That was definitely a gut blow to the administration, and something that I don't know if they were planning or they were intending on taking him out in a strike. But the whole problem
I think his leg was pretty messed up, so I think they might have missed that one on the whack-a-mole.
But I mean, geopolitics aside, you look at where oil's at, you look at where energy, you look at where agricultural products are at. You're seeing even some of the outside energy names like the sugar market, which, remember, converts into ethanol and things like that, pushing up as well. So these inflation expectations going up, 10-year treasury yields up at 4.25. I mean, this does not look good at all. You got the dollar index could potentially break through that 100 in the overnight. You just have stagflation right full front and center. And, you know, gold surprisingly coming down 5,100. Key level supports right around that 50.20 to 5,000 mark. I think we get down there, that'd be a commodity to watch back to the upside.
Yeah, gold might be needed some time to reset here a little bit, but struggling. You know, I wonder if the move in bonds is going to disrupt that. I have to say here is that I was looking for a few things I got wrong earlier this year. Most recently, I was thinking crude was a fade earlier than it has been. But before that, I was wrong because I thought when we left 4.2% on the 10-year that we were going to make a move higher. Now, obviously, we went the other way, but now we're coming back that way. But the point is, I kind of think that you still look at the economy, and other than the jobs miss that we had, the numbers have been pretty consistently strong. ISM's consumer sentiment, consumer activity. Tomorrow we'll get a test with the GDP revision. Hopefully that doesn't go down. But I thought there were reasons to sell bonds anyway. So
yeah,
you throw an oil spike on and, you know, higher prices, yeah, maybe there's a real trade here.
Well, all that economic data that you're outlining and what could potentially come ahead, coming out in line, slightly firmer, reaffirms that Fed stance that they're not going to cut rates anytime soon. And if you look at the way that markets are positioning or predicting, they're saying no more interest rate cuts this year. And that's got to be a devastating blow to, the Trump administration. I mean, just how hard he was on Jerome Powell. Jerome Powell's got to be pointing at him, CNC. I told you so. It's not me. It's the economy, stupid, or it's some of the actions that are done by the administration. And, unfortunately, this was not the one-two punch that I thought that the administration was planning for. And it looks like it's escalating into a much longer event than it was pre-planned.
Yeah. The precious metals trade, the catch with that is they had been a sort of catch-all, almost like safety plus speculation all in one, going up kind of no matter what happens. But if you get the move in the dollar, because we're pricing out Fed cuts and maybe pricing in a need to counteract, dollar moving higher could foil that silver trade. Maybe a pun there?
So you're going to need to pair it. Yeah, but what I would do is I would seriously take and look at how the gold market is working in relation to many other foreign currencies and looking at pairs trades where you're long gold, but you take that dollar aspect out by shorting a euro currency against it, a Japanese yen, something that's highly impacted, Swiss franc, by some of the developments over there. Because if you look at gold against many other foreign currencies, it's probably making new all-time highs despite some of the recent weakness we see. So, Dennis Garman, you'd always say, well, gold in euro terms is making a new high. And it took me a long time to figure out exactly what he's saying, but essentially that's what he's looking at. And you look at a lot of foreign individuals, they're probably saying, hey, get me out of my weakening currency, get me out of my weakening, equities, and get me into something like a safe haven play like gold.
Okay. So buy dips on gold. Sounds like maybe you're still thinking?
I firmly believe so. Structurally, we're all still there. Central bank buying, I think, will come in on any type of significant decline. I still believe that there are people that believe that it is a great portfolio diversifier as we do. And I believe that's something you want to own.
Is there a dollar level that ends that trade? Because we're getting pretty close to 100. This thing hasn't really made higher highs since 2025, maybe a couple there. Yeah, going at the end of 2024, going into 2025. This would be a major range if it breaks out above 100.
Yeah, the dollar, that's been the defining range. So we'll see what happens and how it's going to react there. We'll see if there's currency interventions, things like that. I mean, they've got to do some things to control the way this global economy is going, because we went from global reflation to now global stagflation in these markets. On the gold market, back to it just on technically, you want to get above 52.50. A break above there is going to open up the doors for a much higher move. We failed there 2 days ago. Very disappointing on that move, but we've seen just volatility in everything from the yields to these currencies just escalating significantly recently.
It's kind of an interesting who you got, because if you got gold, the 3-year weekly chart just looks hugely in your favor. This looks like a small blip. In fact, it doesn't even look any worse than fall of last year. But if you got the dollar, you might get a little faster asymmetry kind of move there, because there's been so much momentum in gold. It might have a higher bar, perhaps. But look, I'm kind of biased because I just love the U.S. dollar. I'm a patriot, Phil. I'm a patriot. I like the dollar. I love the dollar. But it's also fun to trade because the dollar whips, baby.
Yeah, if you look at the dollar and you start looking at that average true range, only 65 ticks here. So at $10 a point, $650, you have a product that will fit into a lot of portfolios from a volatility adjusted standpoint. You start looking at things like the S&P, well, it's moving 114 points. The NASDAQ 500, the Dow 900 points over the last 10 days as an average on over the last 10 average true ranges here. So you get those kind of movements. Maybe looking at something like the dollar is more of a low volatility play that can work as some kind of hedge and portfolio diversifier for people.
There you go. I think that's the important part, is that you can kind of think about it as a wild card. because the downside I don't think is huge after the dollar got obliterated the last year on this massive upheaval of like trade policy, tariffs, the kind of pressure on the Fed to cut. There were so many things that really were thrown at the dollar, and it managed to stabilize in the last couple months, where I do think that downside might be limited there. So it could be a fun way to throw a little bit of special sauce into the portfolio, almost like dare I say, a BTC. At this point, maybe there's some credibility to that, because if Bitcoin breaks or rips, it could be a monster move too. I have no clue at this point.
I was fairly shocked at the ability for Bitcoin to hold up at these levels. I mean, it seems like it got down to this 62 to low 70s, and now it's tightening up its ranges. And perhaps some of the foreign currency holders are saying, get me out of Australian dollar, Swiss franc, euro currency, get me into things like Bitcoin as this placeholder until we can figure it out. So it's surprising that it is holding up as well. I would have casted it more in the 50,000s, low 60s than where we're at right now, but it's probably the positive correlation that it once had to the dollar, and I haven't checked its correlation matrix here recently.
For BTC?
Versus the dollar.
Yeah, I'll pull that up for a sec on the futures. What do you like, Phil, 30 days?
I mean, I think so.
Okay.
And we'd have to look at this stuff, from these shorter term perspectives. I don't think you can marry anything in these environments, because if you do get the conflict resolution, or if you start to look and see, this becomes like pattern recognition. You come in tomorrow, and if you see oil down, $6-8, your first inclination is going to be buy the dip, but you got to check the headlines real quick, and then you start looking at how's the dollar doing, how are treasury yields doing, and then you could start looking at things like the Russell and going long, like a TLT or a 10-year note as your play. So I think that the setups are there for another phase transition, but who knows the way this conflict's going.
Yeah. The Bitcoin dollar relationship, kind of interesting. The correlation going back negative. They actually had been positively correlated for a bit. It definitely goes back and forth, but when the Bitcoin was sideways to down, the dollar was also kind of sideways to down there. So that was kind of an interesting moment where they both just kind of drifted lower. But I think that was basically because gold was sucking up a lot of the flows from everything. It was like stocks basically and gold or silver. So if gold and silver come off, you could have an interesting situation where the dollar kind of wreaks havoc on everything. But I think that would take a really powerful move. And I do think we know that as soon as is possible, the president's going to come out and start jawboning Fed and rates again and say, we're done. It was quick. We're out. No more. But I don't think you can reasonably do that if oil's trading at $100.
No, not at all. So, and I mean, you start getting all these different inflation components moving back up. Something that, slightly off topic are like mortgage rates. And just when that conflict was getting ready to go, and it was that weekend, one of my friends is a mortgage broker, was like, should I do all these locks right now? And it was like, not a bad idea, and locked in those lower rates. And now I can only imagine that yield's got to be going up significantly on like 30 years and whatnot.
Yeah, no, that's fair. 10-year yield 4.25 right now. Certainly is pushing up to the recent highs from Jan. And we get a little, topsy-turviness, hikes, maybe not hikes getting priced in, but cuts getting priced out and yields go up. It's been the relationship for a while, though, the way that works. But with all of it, Bitcoin actually holding in there today. So maybe some hope springs eternal here. I feel like the cross-asset assessment, always good at it. I think the dollar is a big part of it. So buying the dips on gold, same apply to silver?
I believe so. Silver looks really good in comparison to what should be going on in that market. You also have copper futures holding up quite well here. Copper's got a defined support level, which is right around 564 on the downside. Saw a lot of dip buyers come in there. Saw a lot of sellers come in at the 595 on up to just anything slightly over 6. So that's a product here that you get. The AI story's just been non-existent here at the moment, at least from a headline news. And if all of a sudden, these AI companies, these data centers are using some of this, distraction where they could refocus their efforts and things like that. They could get things positioned. This tells you that things like copper, having that type of electricity rather than utilizing things like natural gas and crude oil and gasoline, just makes complete sense. Going back to the grid, going back to solar and things like that.
Love it. Ready to buy dips on metals for reasons also, not just currency-wise, but a little secular trend. Nice, love it. You demand for the commodities. Nobody beats him. Phil Streible. Thanks, Phil.
Thanks a lot. Thanks, Rob.
You got it. Chief Market Strategist at Blue Line Futures. All right, we got the bell in 9 minutes. We're going to take you up into it as equities are trying to find some reasonable strength. Not much, but we are up off those lows. Scott Bauer taking us into the close. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Okay, here we are as stocks slip towards the lows of the day. Just not able to hold on to just the slightest of bids in the last hour, as we are getting hit pretty hard. Market now down 1.4%. So that's pretty much the lows. Here's a look at the S&P 500 futures as we're just plugging right along to the downside, 6680. Iron, maybe that's 6600. The intraday low from 3 sessions ago, Friday into Sunday, night was at 65.84. So we're pretty close, and now that 6,800 looking like maybe it became resistance, which certainly would not be good. Got Mr. Scotty Bauer popping into the Zoom right in time for the closing bell. Scotty, what's going on? Market is unable to hold a bid. What's up with that?
It is ugly, sir. It is ugly. It is ugly. You know what? It's about, yes, oil. It's about interest rates. Bottom line, it is about interest rates here. And we talked about it yesterday. We talked about it the day before, last week. This is a massive move. And we talked about, even if we got past 430 on the 10-year, we got up to 450. Could the market hang in there? Well, you know what? The market is really struggling right now with a 430 almost handle. And I think that just shows how much more fragile the overall market is right now than it was just a couple months ago when we were at 430. So we definitely have to watch this here. I mean, this, what we're seeing happen in the Middle East is really having a massive, massive ripple effect down to our economy.
Scott, the bond move, to your point, certainly complicates it. As you know, I was thinking earlier in the year that yields were going to go up anyway, so you toss in higher crude, maybe that makes sense. But obviously this is not the way we want it to go up. No. That said, other than a jobs miss, the data have been largely okay. Jobless claims right in line with expectations today, below them by 1,000. Tomorrow could be a big deal. We've got the GDP revision, but more importantly, we've got PCE, and we've got also inflation, GDP, durable goods. That's what I'm looking for. There's durable goods. Yeah.
It's going to be interesting with PCE. Is that going to show something somewhat tame like CPI did, or is it going to show something different? The CPI number was okay. It was pretty good. There were a lot of caveats, though, about, didn't include what happened with the beginning of conflict with Iran. So what is PCE going to show right now? I think the market is expecting a hotter than expected number.
It's a tricky one to figure out because the bond yield's moving. You kind of got this backwards environment where if we're not going to cut, yields are going up. Which is always kind of fun as we price in hikes, yields go up. Love that. But that's kind of, maybe it's reordered itself a little bit actually in terms of some kind of traditional relationship because a couple years ago when we first started cutting, yields are going up as we were cutting. So this might be a little bit more traditional by some standards.
Yeah, I think what that goes to show you, Oliver, is the massive amount of volatility, not just in the equity market, but in the bond market and commodities, and that we really don't know what the next move is going to be. This volatility we're seeing, again, we've talked about it, it's great for traders, not so great for the overall market, but we're coming down a pretty critical area here. S&P is just a little bit lower here. We've got to hold that. We really have to hold that, or this thing can flip pretty quickly here. I actually think, personally, we are way oversold. I really do. Now, maybe I am discounting the fact that this situation with Iran maybe is going to last longer than many would hope. If it does, that's not going to be good for the markets. It's not going to be good economically. I'm more of the camp that it's going to be shorter rather than longer. So, I think even right now, even though it's not a so-called technical level, you look at whether it's the S&P, the Qs, you want to look at your favorite stock. I think it's good time to dip your toes in a little bit. I've been doing them with selling put spreads and selling iron condors, as we have spoken, because premium levels are just so expensive.
There's the bell right there. VIX 27 is where we end. S&P 500 down 1.5%, almost right along there with the rule of 16. Maybe still a little bit small of an S&P move, but volatility. We did catch up in terms of the realized move today compared to where VIX was when I walked into the Cboe floor at 25. So tell me tomorrow, Scott, let's do a hypothetical here. Let's say the market doesn't like what it sees from the data tomorrow or whatever reason. Let's say we get down to 66 in the S&P. VIX is pushing above 30. Tell me how you approach that as a last thought here.
I mean, that's the area I'm looking at, man. And if we get there, I'm definitely going to be buying, but I'll have some pretty tight stops.
And you do it through if we get
I would more than likely do it through selling put spreads.
There we go.
Just because, if I get in a position, I'm not looking for what's going to happen 2, 4, 6 weeks, 8 weeks from now. It's not an investment. It's a trade. So I would be looking to take advantage of this massive premium that we're seeing.
Yeah. To your point about oversold, we're getting close to 30 on the RSI. Not quite there, but it's been deteriorating steadily, so it certainly has gotten intense. Market couldn't hold up there today. Too much to bear, I guess. Dollar did end up adding 0.5%, and crude oil almost a double-digit move to 9.28. Looking for maybe a touch of that 6,600 to slam the put spreads again in hopes that this thing can stabilize like it's got. Thanks.
Yeah.
Appreciate it, sir.
Have a good one.
Glad we got you in the bell there. Scott Bauer, CEO of Prosper Trading Academy. Scan the code, learn how to trade. Man, help me do it. All right. Rough session. Stocks couldn't hang in there. But at least we're still above possible support, 6,600. Good luck with that tomorrow. I will see you Tuesday, 2 p.m. Central Time, Chicago Future Finance. Thank you for tuning in this week. Appreciate it. Have a great night.